Good evening, madam. Can we start?
Yeah, I'm ready. We can.
Okay. Okay. Good evening, everyone. Today, we are hearing the fourth lecture series that we are conducting on the topic Indian economy at 75 years. For today's lecture, we have Professor Lekha Chakraborty from National Institute of Public Finance and Policy, New Delhi. She is a PhD holder from Indian Institute of Science, Bangalore, and also the recipients of the Best Thesis Award of Infosys. And she's also an elected member of International Institute of Public Finance Policy, Munich. And she's a pioneer in introducing, institutionalizing gender budgeting in India. She was also the Chief Economic Advisor, Government of India. Her area of research, macroeconomics, public finance, fiscal federalism, etc. And she has published many books titled Public Economics, Macroeconomics of Public Finance, Fiscal Federalism, and many other papers, especially published by the noted publishers, Sage, Cambridge University Press also. Then she's also associated with IMF, UNDP, UN, and also the Commonwealth. Then she was also a twice recipient of the Shastri Indo-Canada Fellowship, and she has contributing regularly in many leading newspapers and also a regular writer in economic and political weekly. Especially, many of us might have gone through your article on the discussion on budget in economic and political weekly, which came very recently. And that the topic that she is going to present is macroeconomic policy in response to pandemic. On behalf of the Center for Budget Studies, faculty members, students, and many others who have joined with us, I extend a warm welcome to you, madam. You can take 40-45 minutes for your presentation, followed by I can take, or if I have some discussion after that. Regarding the audience, the Center for Budget Studies conducting a course on econometrics and financial technology. Students of that course plus the students from neighboring colleges and students from Department of Applied Economics and some of the faculty members are also attending this. So on behalf of everyone, I extend a warm welcome to you, ma'am. Can start.
Thank you. Thank you so much, Professor Hari. It's like homecoming for me.
That we know.
Yeah, it's absolutely, it's an honor and privilege to speak to the faculty members and the students of Center for Budget Studies. And, when the pandemic worries are over, I hope to come over to your campus later. And thanks again, to Dr. Santosh for coordinating with me and make this possible for me. Now, I will be speaking to you on the macroeconomic policy responses to the pandemic. And here, things were a little different right now because of the global uncertainties. And fiscal policy has been very accommodative throughout, and monetary policy has done a heavy lifting. But despite all these policy responses, the growth, that scenario, the macroeconomic outlook, it's not that great when you take a look into the global uncertainties right now. In the sense, energy price volatility and the mounting inflation and war in Ukraine, all these, factors are going to neutralize the growth recovery we have experienced. Though we experienced a short-term recovery, that recovery is going to get neutralized by this increasingly, mounting inflation and other global uncertainties. And how these exogenous supply side shocks, how it can be maneuvered through the fiscal policy and monetary policy, that's quite crucial. Now, let's take a look into the central bank, monetary policy reaction function first before I get into, the fiscal policy. You must have seen the State of Economy report, which is just out 2 days back. And in the State of Economy report, and also with the Monetary Policy Committee report or the minutes, we can see that the sequence of priority has been shifted from, growth first to tackling the mounting inflation. So far, we have kept our policy rates, the repo rate especially, at 4% since May 2020. And we have kept the interest rates at the low rung just for the economic recovery process, for the sustainable economic recovery process. But right now, with the mounting inflation, the articulation from the central bank governor is that it's not, growth first strategy we can prolong, but we have to get into the mode of reversing the sequence of priority to the mounting inflation. I don't know whether students have taken a look into the work by Rubino. He has written a wonderful piece that appeared in Project Syndicate. The title of that piece is, Russian War and Macro Policy Response. So there, he beautifully articulated that if the center bank bites the bullet and hike the interest rates, then, the growth recovery process is going to get affected. But if the central bank doesn't bite the bullet, then this mounting inflationary pressures, how we can tackle. It's not only the mounting inflationary pressures, we have other global financial pressures from, US Fed Reserve as well. In the sense, in the Jackson Hole meetings, we got the narrative early next year, and the next Jackson Hole meeting will be very soon. So the articulation was that Central Bank of US will be going ahead with reducing the balance sheet of US Central Bank, Fed Reserve. And if they are going to do that, it's a kind of taper tantrum, and inevitably there will be a series of hikes in the interest rate by the US Fed Reserve. So if that hike in the interest rate happens, unless RBI raises the interest rate, then capital can be flighty. You know that in the foreign exchange reserve, a part of our reserve is hot, and the hot money respond to the interest rate differentials. And unless India increases the interest rate, there could be, capital flight. So this is one fear. And our financialization of savings. We have kept the interest rate lower, but that was affecting the financialization of savings. For instance, as per the new monetary policy framework, as per the inflation targeting, we have a nominal anchor. That nominal anchor is 4% inflation, which is officially plus or minus 2 band. So up to 6% CPI, that's within the comfort zone. But we have seen that consecutively, 3 quarters, it was crossing 6%. So with, the repo rate at 4%, and if the interest rate is mounting above, the comfort zone of 6%, then we are experiencing a kind of negative interest rate. And in the last MPC meetings, in the press conference, RBI governor has articulated that he will be looking into the zero bound real interest rates and the negative real interest rates, because it's going to affect the financialization of savings. And if unless we increase the interest rate, then there's a huge tendency to diversify the savings from the financial savings to other sources. We may not go ahead with high return, high risk assets, but even then, the term deposits, we are not even getting what we deposited. That's what is a negative real rate of interest. So on one side, the question regarding the financialization of savings, the negative real rates of interest, the capital will be flighty if you don't increase the interest rates. And also we have mounting inflation. So it's inevitable to increase the interest rate. But if we do that, if we buy the bullet and go ahead with increasing the interest rate, what happens is it is going to affect the growth recovery process. Because for the growth recovery process, we need to keep the interest rate at a lower level. Why? Because the credit will be cheaper. Then that inversely related, that relationship is inverse, between investment and interest rate. But it's not one-to-one, because with that policy tool of interest rate, RBI could not, get into that growth recovery process just one-to-one. So interest rate is not everything. We need to have, crucial fiscal policy dominance in order to get, the growth recovery in a sustained manner. That's a different story. But now I'm into this monetary policy reaction function. So interest, that is pegged, the policy rate is pegged on the basis of, that inflation anchor and its deviation from inflationary expectations and output gap. And here, that inflationary expectations, that's an unobserved variable. And RBI has floated expectation survey to get into this variable. And then the output gap, again, that's a very tough macroeconomic variable, because the potential output is computed by, filters, by taking out the cyclical components, and we call that trend as the potential. But it's quite controversial. So based on this rules-based monetary macro, the inflation targeting, we peg the interest rates. And unless there is a monetary policy transmission mechanism, then these low interest rates, the policy rates, will not get into, the commercial banks' interest rates, and ultimately it will not be helpful for the consumers like us. So the monetary policy transmission mechanism is also quite crucial. Now, the latest articulation of RBI is they can't wait for long for the normalization procedure. Normalization procedure means we are going to roll back the policies which we announced as a part of pandemic package. So one instance is monetary policy corridor. It was like the upper bound is, of course, the marginal standing facility rate. That's an overnight rate, which was 4.5, in which that lending process happens. And the floor was reverse repo rate. And reverse repo rate is a rate in which the commercial banks can park back the liquidity with RBI. So there, in order to not getting into a neutral stance, because you have to see the articulation of the center bank, we are not moving ahead from accommodative, that space to neutral space. All what was articulated was like it's a withdrawal of accommodative space. So how they have done that withdrawal of accommodative space by maneuvering the, the monetary policy corridor, they have adjusted the lower bound of the monetary policy corridor by introducing a new policy tool, and that's exactly, the standing deposit rate, which is 3.75%. So you can ask me whether this reverse repo rate at 3.35, that's redundant, because since May 2020, we kept the reverse repo rate at 3.35, but it looks like it's redundant now because the SDF, that's going to be the new floor of LAF, the liquidity adjustment facility. So that's a way they have maneuvered the monetary policy corridor, to absorb that excess liquidity that was in the system. So if you ask me that if they don't touch the policy rates and if they reduce the liquidity in the system, can we call that policy stance as, hawkish? Of course, that can be called as hawkish, but they have not touched that repo rate that's still at 4%. So it's a smart move, because if you increase the repo rate, that will affect, the growth recovery process. So instead of, playing around with that repo rate, they have introduced a new policy tool that's a standing deposit rate at 3.75. But even before that, informally, this normalization process was on. That macroeconomic responses to the pandemic, and now earlier than expected, taking back of that policies, that's called the normalization procedure. We have done because, the call money market rates, when you look into the term structure of interest rate, the call money market rates, those rates were below the repo rate, but now it's getting adjusted. And the long end, the government security rates for over, 10 years, 15 years. So that cutoff yield rate was also going haywire. So in order to look into this term structure of interest rate as well, this normalization procedure, that was quite crucial. So that's why this earlier than expected informal normalization procedure happened by, going ahead with VRRR, that is variable rate reverse repo at 3.99 cutoff yield, and also by not getting into an aggressive, the government security acquisition. So these were the ways in which RBI was getting into an informal, process of normalization procedure. Now, if the inflation, that CPI inflation is an inflation that's a nominal anchor of the RBI based on this inflation targeting framework, not WPI. WPI, of course, we have seen the recent numbers, it's mounting about 13-14%. That's a different story. That's divergence between WPI and CPI inflation. That's also a matter of concern, but in the sense, RBI looks into only the CPI as a nominal anchor, and that's when if you take a look into the forecast, they have done a downward revision of growth forecast. But more than that, if you look into the interest in the inflation forecast, it's very close to 6%, 5.57. It's very close to 6%. And in reality, we have seen 3 consecutive quarters many times in this pandemic era, that CPI crossed that nominal or that allowed comfort zone of 6%. Now comes the question of efficacy of inflation targeting framework. So does it mean that, RBI has to, RBI is answerable if such things are happening? So what way RBI is going to respond to these things? Will they, get into an amendment of this new monetary policy framework by getting into a new comfort zone of a nominal anchor, maybe a revision from 4, and even the band revision of ±2, or are we going ahead with more than 6%, that official comfort zone? Because then it's officially allowing, 7% or something to happen in India, the inflation. So I don't think, but, there are empirical evidence. The empirical evidence is inconclusive when we look into the question of whether RBI is able to, maneuver or anchor inflationary expectations. So that's a big question, and that's inconclusive if you look into the empirical evidence. And recently, Ashoka announced a paper by Pilapre Balakrishnan. He also looked into this question where the efficacy of inflation targeting framework in India and the way in which they are going to anchor the inflationary expectations that's happening or not. Because the exogenous supply side shocks, it's not a straight monetary phenomenon, this inflation in India. So this exogenous supply side shocks, how this inflation expectations channel, anchor it, the empirical evidence is inconclusive. And we have to wait and see what RBI is going to do about it. But it's, of course, a very smart move of articulating to the investors that we have, gone ahead with, inflation containment prior to the growth. Earlier it was growth first, but now they have changed the stance to, inflation first, because, a lot of criticisms were there that, RBI has fallen behind the inflation curve. Then this time they were bound to, answer that we are going ahead with the priority of growth next, the priority of reversing the sequence of priority by giving importance to inflation containment. Because by mandate, RBI needs to look into only inflation containment, because growth, exchange rate management, all that comprehensive, monetary policy reaction function that was prior to this new monetary policy framework, which was based on the Urjit Patel committee recommendations. So we have gone ahead from those, era of a very comprehensive monetary policy reaction function. And the predominant way the macroeconomics or the macroeconomic policy response to the pandemic from RBI was, of course, by keeping the rates lower and also by doing the credit infusion into the economy. That was a predominant, narrative. And credit infusion, of course, one method was they introduced Operation Twist. That is in the process of elongation of the maturity structure of the debt market. In the sense, they involved into a kind of simultaneous buying and selling of securities. In the sense, you simultaneously buy a lot of long-term and sell a lot of short-term securities, so that the refinancing risk is getting postponed. Then you will get more space for this liquidity infusion. So that's one of the toolkits they have tried in the times of pandemic. And another important toolkit of this liquidity infusion was they got into this targeted repo rate operations by liquidity infusion into the stress sectors, and that was quite crucial. Many sectors, those stress sectors, were looked into through that targeted repo rate operations. And then we have the usual OMO, and now what is controlled is that OMO operations. That was clearly mentioned in the press conference by governor, that we are not touching the Operation Twist, but all what we have done is the acquisition of government securities, that's getting phased out. And also, H1, if you look into that number, H1 financing of deficit pattern, if you look into the H1 market borrowing, that's just touching 60%. We have done a front loading in a sense. So that has got huge pressure on the yield. So we have to look into all these aspects. And that rally of yield in the market, that was, a matter of concern. So many things we need to look into when we talk about the credit infusion and, adjusting with the policy rates. Now, recovery was uneven. When the predominant narrative of the macroeconomic policy, response to the pandemic is through credit infusion, it's bound to happen. The, recovery is bound to be uneven. You know why? Because the access to the credit was uneven. And if you look into the credit deployment statistics of RBI, you can see that, who access the credit. And you may see a YOY increase in the growth rate of the credit in small and medium term enterprises, but the magnitude of the credit, or if you look into the composition, there was some kind of fear in accessing the credit, in the sense, when the demand is not stimulated, when you are not sure about your markets, then accessing the credit, especially the small firms, they think twice because, the repayment, that is very crucial, right? Then they should not enter into a Ponzi game to repay the good lemon, that credit deployment that has happened, and they accessed it. So fearing the repayment, many small firms didn't even access the credit because the markets were uncertain and they were not sure about the demand. So the predominant narrative of the pandemic package is credit driven, then it's a matter of concern. And Stiglitz and Rashid, in their article titled "Which Economic Stimulus Package Work" or "Which Economic Stimulus Works," in that article also they have highlighted the limited multiplier effects of the credit infusion or the credit deployment as a predominant narrative of a economic stimulus package. So that's a story about the monetary policy stance. Now, fiscal policy has been very accommodative. And in the sense, we have very high fiscal deficit and very high debt. And of course, there are questions about the intergenerational inequity this high deficit and high debt that can create in the economy. But the the articulation even from the IMF is towards a very accommodative fiscal policy stance, because that's very crucial in the time of pandemic. The fiscal risk and all we have to tackle in the long term, in the sense that excessive deficit procedure part, that's medium term. And in the budget 2020, finance minister announced that it will be medium term. The fiscal consolidation will be medium term, because we cannot get into that fiscal consolidation right now because it will affect the growth path. In the sense, by 2025, we are going to reduce the fiscal deficit to GDP ratio by 4.5, not even 3%, which is the original threshold ratio of fiscal deficit to GDP. So in the time of pandemic, the efficacy of the fiscal rules, that is also under scrutiny. And as Oliver Blanchard rightly mentioned, in the time of crisis, we need not fear about the high fiscal deficit or high debt if it can be substantiated by increase in the capex or the capital infrastructure in the economy, or if you reduce the output gap. So that's a narrative, and it was well taken. If you're focusing on the human development, capital formation, and if you're focusing on capital infrastructure, that is going to crowd in rather than crowd out investment. In the sense, there is a intergenerational equity also over there. You are not getting into an intergenerational equity by putting the future generation into debt or anything, because there is a kind of intergenerational equity if that use of public debt is for human development, capital formation, and infrastructure, because it's going to crowd in. And I know that my book, students might have read, that book is titled Fiscal Consolidation, Budget Deficits, and Macroeconomy. So in that, one of the chapters of my book, I looked into this question of financial crowding out and direct crowding out. I was looking into the macroeconomic consequence of deficit. But that time, that book was published prior to the pandemic. Our country was not in a mood to accept that argument in the book. A timely deficit is so good. A deficit is good. So that was the argument of my book. But, that was not the right time to pitch that argument. Right now, from the position of strength, everybody argues for a timely deficit, and that's going to be growth enhancing. But that time, when we were into strict FRBM and the empirical studies that was inconclusive, they're inconclusive in the sense, growth discipline is growth enhancing. Fiscal discipline is growth enhancing. That question need to be looked into. But many times, fiscal discipline may not be growth enhancing, because if you take a look into the path towards the fiscal consolidation, and if the path is through expenditure compression rather than the tax buoyancy path, then the quality of the fiscal consolidation is going to suffer. That's why the efficacy of the threshold ratios is under scrutiny in the time of pandemic, more than ever, because these are extraordinary times, and fiscal policy and monetary policy that needs to be on an extraordinary pitch to face this pandemic. And on the top of that, we have now global uncertainties and energy price volatility, food inflation, and it's a lot of complicated scenario we have if you look into the global scenario. So we cannot even think of a threshold ratio of fiscal deficit to GDP at 3% through expenditure compression, because those kind of, that fiscal austerity measures can be, detrimental for the growth recovery process. That's why, if you need to have a fiscal rule, keep it, but don't use it in the time of pandemic. And if you fear a bad equilibrium, then you get into a medium-term fiscal consolidation path, because this is not about fiscal profligacy by high debt and high deficit. We are not talking about a fiscal profligacy, but these are the crucial, public expenditure decisions we need to take. Otherwise, if revenue stability decides the public expenditure decisions, then when revenues are uncertain, then you need to go ahead with, fiscal austerity measures. You need to go ahead with expenditure compression. And in the last budget, we have seen that a kind of informal normalization process that has happened in India. And in the time of pandemic, in order to even prevent a civil war, that food security was quite crucial. When you design a package, you cannot focus on just growth recovery or GDP. You have to look into the humanitarian crisis, because otherwise it will mount into other kinds of social tensions. So food security was one of the crucial, component of the economic stimulus program. So in addition to the growth recovery, the components like food security, then social infrastructure, especially the digital divide that's happening in the Indian economy, the learning loss that's happening due to the digital divide, and of course, that investment in health. But I think we didn't use this crisis as an opportunity to look seriously into the public investment in health sector. Because if you look at the numbers at the central government level, the public investment to, investment on health to GDP, that's below 1%. So we haven't taken that sector quite seriously. God forbid, next wave, God forbid. But otherwise, right now, it has to be the investment in health sector which can prevent the health crisis mounting into a prolonged macroeconomic crisis. Because lockdown, night curfews, these strategies, non-pharmaceutical intervention strategies, that can lead to irreversible economic disruption. So investment in the health, that's quite crucial. But we haven't used this opportunity to, this crisis is an opportunity to look into that sector quite seriously. But of course, the economic pandemic package, there were two important components. One was this firefighting component to look into the cyclicality of, growth recovery process. And the other was the structural reforms component. And when you look into the cyclicality, the analytical framework of the pandemic economics is very crucial when you design the macroeconomic policy responses to pandemic, because the deviation of GDP from that prior pandemic path, that deviation, that's not just a transient deviation. It was a permanent scar. When the scarring of the sectors, or when there is permanent scar in the growth process, just confining to the fiscal and monetary policy tools as a counter-cyclical policy tool, and believe that this cyclicality that will get eliminated and you get the growth prior to the pandemic levels, that's going to be a little tricky. That's why, we need to focus on the structural bottlenecks, because these permanent scars can be tackled only through the structural reforms. And of course, there was articulation about the structural reforms in the context of India. For instance, the fiscal space at the subnational levels, instead of 3%, now the states can go up to 4%. But that extra borrowing space, that is linked to a structural reform package, in the sense the 0.5 of that 4% of GDP fiscal deficit is linked to the power sector reforms, because power sector reforms is very crucial. We have enough power generation in India, but we don't have, distribution companies, out of mess. So if the distribution companies are not doing well, we need to support them to get, the power outcomes or the power reforms intact. So the state governments, if you look into the statistics, the official financial parameter, efficiency parameters, and the operational efficiency parameters, if you look into, these are not great in the context of India in many states. So that's why, this pandemic time is used as an opportunity to float the power sector reforms. And the Ministry of Power gives you that, the data on financial parameters, efficiency parameters of aggregate technical and commercial laws. And NIPFP has a study. I co-authored that study. You can take a look into that to understand, things are not good. Despite supporting the discom companies, the state finances got deteriorated, but the efficiency parameters are still not okay. Now, we announced even privatization of discom, but even after that, if you can access the data and see the efficiency parameters, that's not good at all in many states. So these are concerns. And of course, labor market reforms are very crucial. And farm sector, we repealed it, so that's very crucial. So we have to get into many structural reforms package as well. Otherwise, this cyclicality, just focusing on fiscal and monetary policy tools as just counter-cyclical policy tools can lead us to a problem, because that, downturn in the GDP, it is not, just a transient drop. It can be permanent scar. So we need to be aware of that paradigm. And business cycles, if you use as a framework for getting into this pandemic crisis analysis, you may run into problems. And as that cyclist trend paper articulates, that paper was written by Mark and Geeta Gopinath. So they articulate that in the context of emerging countries, you need to see whether business cycles, you can date business cycles like ups and downs, or you need to look into the hysteresis. It's a long-term dependence of that dependence of your economy on the history, that long-term path, and how the short-term dynamics is going to affect your long-term path. So these are very crucial when you look into the analytical framework of growth, when you analyze the growth paradigm. So these are important matters of concern. And now new tendency is to look into the fiscal risk, because fiscal policy has been accommodative for so long, and the debts are mounting. And of course, in many countries, the debt that's crossing 100%, but we are quite worried that in India, our general government debt is around 90% or a little above that. So we are worried about that. But, if the real rate of interest is below the real growth of economy, then a sort of debt sustainability is there. That's the only free lunch we can have. But if the real rate of interest is going above the real growth of economy, then things won't be okay. So threshold ratios, of course, we can forget for a moment. But if the R is greater than G, then we have to eventually monetize the deficit, which can be inflated. We have to get into this financing pattern of deficit as well. So if you look into the financing pattern of deficit, over the years, we have controlled the seigniorage financing of deficit, and we are now into the bond financing of deficit. And that's a predominant narrative. But unlike Sri Lanka, we don't have a huge dollar presence. Our external financing of deficit is quite negligible. So that will protect us from this external shocks or exogenities. But you need to take a look into that. And my final point is the macroeconomic policy responses to pandemic, that was not just confined to the economic growth paradigm. We have extended it to sustainable development goals, as well as in particular, the climate change risks and uncertainties. So if you take a look into the recent articulation in the financing pattern of bonds or the market borrowing, there was a thematic bond financing which is linked to the climate change commitments, and the green bond, the sovereign green bond, which is earmarked for the energy infrastructure. So that commitment in the Glasgow, that's very crucial. And monetary policy, if you take a look into the recent articles by RBI, even in the State of Economy report, greening of monetary policy is given quite an important space in the monetary policy. But it's a matter of concern, because economists do believe that, monetary policy cannot go political, because it leads to reputation risk of the central bank governor if they get into the green bonds and the brown bond business. Only the political economy of the green bonds can be managed perfect by the center, not center banks, but the government. So that's exactly the articulation of even Rekuram Rajan. We cannot get into the political economy, and that can lead to reputation risk. And students can also take a look into that Hansen's work in Journal of Monetary Economics, where he argued that why, if central banks move away from price stability and financial stability and get into this climate change risks and uncertainties, how they can affect their monetary policy reaction function. But lack of toolkits is not a sufficient argument not to get into the climate change crisis, because this climate change uncertainties and risk can very well get into the financial instabilities. So the financial instability report published by RBI recently, quite mentioned about the mounting NPAs in future, because the credit deployment is happening, but we don't have any corresponding growth in the economy. So that will definitely lead to the mounting NPA. So students can also take a look into the financial stability report of the RBI, in addition to the Monetary Policy Committee minutes and the recent State of Economy report, the RBI bulletin. So that's it. And fiscal marksmanship and budget credibility is quite crucial. So we will be looking into the fiscal risk and all in the future by focusing on the excessive deficit procedure. But right now, what is budgeted, that needs to be translated into what is the actual outcomes. Otherwise, the budget credibility in the time of pandemic will also, get haywire. So these are the quick things. Maybe over to you, Professor Hari. We can open the floor and I will take the questions and respond. Thank you so much.
Okay, thank you, Professor Lekha, for giving an excellent narration of the state of economy, especially the macroeconomic policies after the pandemic. Now can take a few questions, and now please raise questions. Madam is ready to explain it.
If some questions are there in the chat box, you will help me, no?
No, no questions in the chat box.
Chat box, okay.
Hello, ma'am. Hello, ma'am. Am I audible?
Yes.
Hello, ma'am. Am I audible?
Yeah, we use it.
So my question is, as you said, the lockdown and night curfew may be irreversible. Hello, am I audible?
Manu, there is some breaking of voice is there. Manu, you will repeat it once again.
Yeah, I couldn't hear. Manu, can you repeat the question? Because, even the keyword I didn't get. If I get the keyword, that you'd please repeat your question.
Hello, ma'am.
Yeah, it's you who appeared from the Center for Budget Studies window?
Yeah.
Okay.
As you said, the lockdown and night curfew may lead to irreversible economic destruction. Then what actions can be adopted in such pandemic situations to avoid such an economic destruction?
Okay, I mentioned that how we can, your question is about how we can prevent the irreversible economic disruptions, right?
Yes.
in the beginning, different countries responded to the pandemic in different ways. For instance, South Africa responded to the crisis by focusing on aggressive testing. So test was their strategy in the beginning. But in the life versus livelihood framework, what India has adopted was, giving importance to life first. And we have gone ahead with a sequential, kind of addressing the issues related to livelihood. And we have seen that led to the mounting, migration crisis and irreversible economic disruption. So one thing is, instead of sequencing the policies, it would have been simultaneous, but it's all in retrospect. We are talking about what, that ought to be, the policies to prevent the, that irreversible economic disruptions. But in that ought to be framework, the emphasis on investment in health should have been given more importance. So it's all the retrospective analysis I'm doing, like investment in health to prevent the health crisis mounting into a prolonged macroeconomic crisis was very crucial. Second, in the process of addressing to the livelihood concerns, in the paradigm, instead of focusing too much on the growth recovery, the components related to, the human development financing, like, as I mentioned earlier, the food security, the social infrastructure, the social protection measures, and also, predominantly the government acting as an employer of last resort, that would have been very helpful because in the time of pandemic, what we have seen is the employment has gone down like anything. So that employer of last resort policy should be given importance. But the question was constrained fiscal space. Revenue stability was everything for designing the expenditure priorities. When revenues became unstable, we thought that disinvestment proceeds can be a wonderful methodology to increase the fiscal space, but that didn't work. If you look into the fiscal marksmanship, we didn't get that fiscal space through disinvestment proceeds or privatization. So fiscal space was constrained, but of course it's cruel that there is no fiscal space, we cannot address the humanitarian concerns. So that's not what exactly the articulation, but enhancement of fiscal space. What next? That's a question we need to address. Of course, by reprioritization of expenditure, certain things can be addressed. But if that doesn't, even a re-emergence of, other kind of, innovative financing of deficits and other things, we need to look into to, prevent an irreversible disruption in the economy. There, fiscal space is quite crucial because we have seen that monetary policy stance has got its own limitations through the credit offtake, credit deployment methodology.
Thank you.
Manu, yes.
Thank you, ma'am.
Yes, next. Next question, please. Yeah.
Good evening, ma'am.
Good evening.
My name is Arshad. So, how the introduction of central bank digital coin will affect monetary policy in India?
Okay, thank you so much. I missed that in my talk about, the CBDC and the crypto. Thank you for asking that question, Ashit, right?
Yes.
Yeah. Crypto is not what do you call the digitized legal tender. Crypto is a speculative asset, and we have introduced the tax on crypto at 30% because the tax on the speculative assets is done at 30%. So that's the way, the crypto is taxed at 30%. But the taxing the crypto doesn't make it legitimate or legal because those kind of regulatory framework about the crypto, that high return, high risk asset, that has not yet happened in India. So in the press conference, we asked this question to the Ministry of Finance, especially, the tax officials and finance minister. The articulation was that it doesn't make it legitimate. the taxing is entirely a different cup of tea, like casino, horse race, the speculation, many things are taxed at 30%. So crypto is a speculative asset. It's a high return, high risk asset. So we need to tax it. But, to support the entrepreneurs who are engaged into this high return, high risk asset, we need to protect their, interest. So for that, a regulatory mechanism is important rather than announcing of banning the crypto altogether, thinking that it's going to affect the financial instability. So my hunch is there will be an announcement related to the regulatory framework of, the crypto rather than banning it. This is my hunch. But in between, RBI governor, he mentioned that it doesn't even worth tulips. So those kind of articulation is there. But from the North Bloc, of course, there is no inconsistency. North Bloc clearly mentioned that the regulatory framework, those discussions are on board between RBI and the North Bloc. And that's what in the corridors we heard in Delhi also. But I don't think that it's going to get banned. That's a crypto story. Financial integrity is crucial here. And the data privacy is also very crucial when we talk about this crypto. Now, CBDC is not a speculative asset at all. It is a proper legalized, tender, legal tender. So we can be confident about the digital currency. And Ashit can also look into that piece or that article by Barry Aiken-Green, in the Project Syndicate. He mentioned about the digitized dollar in the context of US. In that articulation, he highlighted one perspective from the Treasury Secretary Janet Yellen, that it is so good to get into this digital currency because that can strengthen the financial inclusion. I was taken aback by that argument, like digital currency can strengthen the financial inclusion, but that happens only when you tackle the digital divide in the context of India. When a predominant chunk of population are not into this digital infrastructure, access to the digital infrastructure, then this digital CBDC, the digital currency, strengthening the financial inclusion, that will not happen. Then another argument was, unlike India, the Treasury Secretary Janet Yellen has announced huge macro stimulus packages, to tackle the pandemic in the form of cash transfers into the hands of people. So she believed that when certain parts of her country is highly unbanked, then the digital currency can smoothen the process of reaching out to the people of what she has announced as a part of the pandemic. So these are the kinds of debate that's happening in US. But in India, we need to look into the data privacy. We have to look into how we can track, because otherwise we should not get into fraudulence. That financial integrity is so crucial, and what is that regulatory mechanism? So the narrative from the RBI and central bank, it will take time to get into this regulatory processes and all, but we will soon be announcing the digital dollar, the CBDC, which is a legalized tender. So that's it. But of course, Ashit, if you are going for a globe trotting and if you're using the central bank digital currency, how much RBI can get into your privacy in tracking the kind of use of that CBDC? So these are important questions regarding the data privacy. Those issues, anonymity. So those issues are getting worked out, and of course, in these decisions, financial integrity is very crucial. And in the context of US, in the cross-border transactions and all, they may have a process of Fed wire. So that's a kind of an analytical structure they have. So what exactly is that analytical structure we have in India to track, certain cross-border transactions, to prevent, certain unpleasant things from happening? So those concerns are there, but it's a, model based on trust. It's a model based on financial integrity. We have to wait and see how it's going to get floated. Thanks.
Thank you, ma'am.
Ma'am, good evening, ma'am.
Yeah.
Yes. Good evening.
Ma'am, good evening, ma'am. Ma'am, recently, ma'am, the gold and oil prices are going up, ma'am, gradually increasing. Ma'am. What reasons behind of it, ma'am?
Tell me the final line. What?
Ma'am, recently and oil prices and the gold prices are going up, ma'am. What was the reason behind of it, ma'am?
Okay, energy price volatility that happened, even prior to this Russian war in Ukraine because of the cartel, it's a cartelization that they got into a kind of artificial reduction in the production, and they were trying to increase that global energy prices. But to a certain extent, that cartel move, we refuted in the sense India, US, we have formed a strategic alliance, and we started, releasing that strategic reserves we have. But that's not a permanent solution. But now, after the Russian war, this energy price volatility, that's quite huge, and we need to see the patterns in which that's happening. And it's not exclusively that cartel decisions, because it has gone out of hand right now. But I will not get into the politics of telling that. One journalist asked me, ma'am, if we buy from Russia, will the problem be solved? No, it's all political economic question, which we cannot decide from an economist perspective, from an island of excellence, because we need to look into from that economic diplomacy perspective to get into these issues. But the crucial factor is, of course, this energy price volatility will get into, your inflation expectations channel. And this price, the domestic price, is not only a factor, a determinant of the international prices, it's also a component of the domestic taxes. And of course, freight charges and all is different. So that taxation thing in the time of pandemic, whether a government will use that taxation continuously to raise the, to tackle this crisis, then it's going to be a matter of huge concern, but we have to wait and see. And regarding this commodity prices and the current account deficit, of course, it's widening. The expinism, that's widening. It's a matter of concern. But, we were quite confident that this widening current account deficit can be comfortably financed through the capital flows. But now, that financing of the SAD, the X minus M, the current account deficit through capital flows will also get into trouble. The moment, your capital will get flighty, that hot money component get flighty if that interest rate is going to go up. So it's all very complicated, so we need to co-read this current account deficit and the capital flows that together, because if the capital is not flighty, then of course you can comfortably finance that X minus M. And India has done that, financing of that current account deficit through the capital flows. But now, the articulation of the Fed Reserve, Jay Powell, their chief, that they are going to increase their interest rates. Unless RBI increases interest rates, the capital can be flighty. And then, that plummeting Forex reserves will be of concern, because now it's touching around 600 billion, that mark. But, when you compare with the last October numbers, foreign exchange is now coming down. So these are, complicated macroeconomic questions, and you need to co-read the, energy price volatility, current account deficit, the capital flows, interest rate differentials. Within that, macroeconomic, that comprehensive analytical framework. Thank you.
Thank you, ma'am.
Next. Yes, next question, please. Now, may I just ask you one clarification, that you were mentioning about the innovative things that are to be brought into the policy framework. Can you throw some light on that?
Okay, that's going to be a little controversial. The moment,
no, whatever may be, but let us.
Yeah. innovative sources of financing deficit. And you caught me over there when I mentioned that, we have to go ahead with that. And exactly what was in my mind was what is happening in Kerala as well. I do mean that kind of financing of deficit or financing of the capex that's happening in the context of India, that's happening in the context of Telangana. So these subnational experiments were also in my mind when I talked about innovative financing of fiscal deficit. Of course, that's happening. Let's take the case of Telangana prior to Kerala. Kerala case, it's thorough with you. In Telangana, as I mentioned about this Operation Twist, exactly like that, in Telangana, they have gone ahead with the elongation of the maturity structure of that bond market. If you look into the, the structure of the bond market, their long-term bonds are more like, the repayment risk is only appearing very late. So they have that robust space to get into the growth recovery process. So that's a way Telangana government responded to the crisis when there was fiscal space constraints and when they have to find something very innovative to tackle that constraints in the fiscal space. They have gone ahead with the elongation of the debt market, that maturity structure. Now, how Kerala has responded to this? Because finance minister at the state government level, their fiscal space is quite constrained, especially when the macroeconomic stabilization function, long back it was the function of the center government. Now states are equally exposed to the macroeconomic uncertainties, and the center government is nudging the state governments to go ahead with market borrowing. They are directly getting into the market, so that macroeconomic uncertainty is affecting the state's fiscal space as well. And it is not as entitlement that the intergovernmental fiscal mechanism is working right now, and states needs to find their space. So innovative way in which Kerala has done, more than me, that we have gone ahead with that PSBR, the public sector borrowing requirement, like beyond fiscal deficit, something is there to finance your concerns, but it doesn't get into the fiscal deficit by definition, because you're cleverly doing it by getting the general government deficit and by getting into corporate bodies and public sector enterprises. So this is not really an exclusive example of an innovative financing by Kerala. Central also has done that. There's a lot of borrowing that has happened in the center government, also through the public sector borrowing, public sector enterprises. So that's an innovative way, and they kept it at the annexure, in a table in annexure, those kind of borrowings. That's a way they have given budget transparency issue. And your question is quite correlated with the budget transparency issue as well, because in the time of pandemic, we have fiscal deficit shot up to 9.2% last year. And exactly that's related to your question, that the budget transparency, the innovative sources of financing, but that's not the part of your fiscal deficit. But last year, center government has taken a very conscious decision that a part of this PSBR, the off-budget borrowings, will be incorporated into the fiscal deficit. So that 9.2 was not exactly, if you decompose, it was not exactly the expenditure priorities to respond to the pandemic, but that budget transparency was given adequate importance. So these are political economy questions, more than the technical questions, that how they maneuver and how they understand the right timing to tell about their OBB, off-budget borrowings and incorporating into the deficit. So yeah, it's a question of the budget credibility and the budget transparency that has happened. So these are the quick thought process I thought that I will share with you. We are innovating, because fiscal space is a matter of concern, and more models may come up in future to overcome this fiscal rules. Because if you go ahead with a tight fiscal policy and say that it's 3% you need to maintain, of course, it's inevitable that, you try for innovations, fiscal innovations. And another fiscal innovation is PFM, public financial management tools, because this macroeconomic responses to the pandemic through economic stimulus packages can be just short-term in nature. So when that is rolled back, then long-term public financial management tools will help you to overcome the problems in the long term. So these are the ways in which we can address the concerns.
See, let me just twist it and one ask in a different way. And how do you see the possibility, the gift issue of Kerala? Because even in CDS, there are people who are like KP Kannan, like they are against it, and at the same time, Isaac is for it. And a situation. How do you personally feel this?
I knew that this is going to happen before I go. You know, I will tell you.
Okay, this is not going to be a very public thing, and public nowadays students are attending. So I'm just asking you your personal observation.
Sure, of course. You know, I will be very careful. You can mount the recording into your YouTube. That's not.
It will not be quoted anywhere. Quoted anywhere.
Okay, it's already mounted. Okay, so it's live. Let me tell you, I am with Thomas Isaac, sir. You know, that fiscal innovation is quite crucial because, you know, there is fiscal space constraints, and we cannot say that it is going to create intergenerational inequities because the use of that public debt is quite crucial. So if the use of public debt is done perfectly, then, you know, a little bit that high debt and high deficit can be substantiated. This is one thing. Second, I know that why Professor KP Kannan mentioned that about, you know, this debt dynamics, because he got into another correlation between the tax effort and the debt dynamics. So his suggestion was, if you get into the debt dynamics, that is giving disincentive for the tax effort. Our tax effort is not at the optimal level. So focus on your taxes, focus on your own taxes, not get into this mounting, you know, debt. That's one thing. Second is, we have gone ahead with the high interest rate mechanism, and we have gone ahead with the London market, you know, that purchase. We have involved the London market. It's not internal. So that's another matter of concern. And there, you know, we may need to rethink about if the interest rate differentials are quite high, why should we go ahead with the, you know, that masala bond, the rupee denominated, you know, bond in London market. So that was a matter, you know, maybe Professor Thomas Isaac can clarify, but one way he defended is that, of course, he has not gone ahead with the dollar denominated, you know, bonds. Dollar denominated bonds and rupee denominated bonds, if you compare that masala bonds, it's quite under control. You know, you don't get into the variations of the exchange rate and all that kind of uncertainties. So, but the interest rate differentials, that like, will you get the same amount if you float it within, you know, India? Why you want to go to the London market? The interest rate, that was, you know, it was a huge concern. So we need to look into, now we are getting into this green bond. And when Kerala, when we have done in our state the climate bonds as a part of KIFB, you know, we felt uncomfortable. But look at center government. They are getting into sovereign bonds, which is now rupee denominated, you know. That's an external market, that sovereign bond, which is linked to the green infrastructure. That's happening at the center government level right now. So much before that, Kerala has done that, climate bonds. So we need to see from that long-term perspective, rather than the political economy of that can be little, you know, but the technical details you need to look into. And I do see a point when Kerala is focusing on high debt, because we need to maintain the high capital formation in the country. And if that can be substantiated by using it, not for the fiscal profligacy, of course, I underline that matter. It should not be, you know, fiscal profligacy, but if it is used correctly for human capital formation and, you know, for strengthening the infrastructure, that's of course welcome.
Okay, thank you. Thank you. Now there are two questions in the chat box. Madam, can you see from that?
Yeah. Shihab.
Yeah.
High oil price creates inflationary pressures and leads to higher price of the final goods. At the same time, RBI takes many measures, but how do you assess this? You know, this concern is real, you know, because Shihab, as you know, deciphered correctly, inflation is not strictly a monetary phenomenon in the context of India. So through this inflation targeting framework, how RBI can maneuver the inflationary expectations when a major chunk of your inflation is happening due to the supply side shocks, due to high oil prices, energy price volatility, food inflation. So the way RBI defend is that even the onion prices fluctuations, they can anchor through the inflationary expectations channel, and the aggregate price level they can tackle. So that's a way they argue. But as I mentioned earlier also, exogenous supply shocks, how effectively it can be anchored through inflation targeting framework, that is getting questioned. And we can look into the Pillapres and Parameshwaran's that paper, that clearly shows you, why RBI failed to anchor the inflationary expectations. So, the empirical evidence is inconclusive. But if you look into the literature which support RBI, which support the inflation targeting framework, those literature, the economists who support the inflation targeting framework, they, ask you back a question. Prior to the new monetary policy framework, that's prior to 2016, your CPI was mounting about 10%, 11%. Now the CPI is not mounting to that 10% or 11%. Now it's under control. But we need to ask a question back whether it's due to the powerful anchoring of RBI that things were under control that time, or is it because, as you pointed out, is it because of the determinants like from the international markets, that because oil prices were under control that time. So we need to look into how RBI, tackle this inflation, and CPI is the anchor. CPI, that composition, the basket also has a lot of issues, because even the cassette, CD, hose riding, these are all getting huge weights into the CPI. It's a redundant, these kinds of components in the CPI. So we are waiting for getting a revision in the components in the basket of CPI, and central bank will continue to anchor the CPI, because then investors' confidence will not suffer, because everything is rules based. So the articulation is quite plausible that we control the inflation, the price stability. If you look into the comfort zone, we have not crossed 6 level. So those kind of articulation is very, very convenient if you use an inflation targeting framework. But the question remains that if there is a wide divergence between your controlled CPI and uncontrolled WPI, then the repercussions of that WPI, that's huge. These are concerns, and WPI means it gets into the balance sheet of the entrepreneurs, the way they have to take the decision, the way they face inflation. So it's a matter of concern. So the efficacy of inflation targeting framework, even after 5 years, we have not revised the framework. We are finding it very comfortable because earlier it was CPI mounting, WPI was under control when Manmohan Singh was our Prime Minister. Right now it's like WPI is mounting and CPI is under control. So we need to see this dynamics, and how powerful RBI controls this inflationary expectations is the crucial ingredient over there. Yes.
Which is that article which you are referring, Parameshwaran and Balakrishna?
Absolutely. It's an article by Parameshwaran from CDS. And
yeah. Where it appeared? Where it appeared?
It's Ashoka. I think they have published this work, Ashoka University.
Ashoka.
So I have seen an announcement that but it was a controlled audience thing.
Okay.
They presented, I think. Let's check whether that presentation is public or, can we access that? Recently, very recently, this paper came out.
Okay.
Yeah.
Okay. Any other question?
Ma'am, my name is Jose Thomas. My question is it right time to normalize banks' monetary policies because more COVID waves are coming?
Tell me once again your name and your question.
My name is Jose Thomas.
Jose Thomas, yes.
Is it right time to normalize everything like banks' monetary policies? My concern is more COVID waves are still coming.
Absolutely, that's a matter of concern. Earlier than expected, normalization is happening. And what exactly is normalization? On the RBI side, normalization is you have to raise the interest rate, you have to absorb the excess liquidity. So these are the two predominant ways in which RBI has to go ahead with normalization process. And from the fiscal policy front, the normalization is you have to decrease the fiscal deficit to GDP ratio. You have to control that excessive deficit. So that's a way you normalize and you tighten the fiscal policy space. But as you rightly mentioned, tightening the policy space right now from the fiscal and monetary policy front can be a little tricky, especially when there are cases, God forbid, it should not happen. But of course, that health crisis concern is there. Even otherwise, we have not, completely recovered from that shock. Economy needs time. So fiscal policy needs to be very accommodative. So now, earlier than expected normalization, as you rightly pointed out, if you go ahead with that, it's going to affect the growth recovery process. And now the growth recovery, we experienced a bit, but that was uneven recovery. It was a profit-led economic growth process that's happened in India. And there's a huge inequality question right now. So the use of fiscal space to address the uneven recovery and to address the concerns of livelihood crisis, humanitarian crisis, if you don't use that fiscal space right now, then, morally, ethically, and, it's wrong that we may show our numbers are okay. Like our fiscal discipline is there, our deficit is 3%, but the cost can be huge. So I go with you that we are not ready. We are not ready for a normalization procedure. And even in the fiscal monitor, which was published by IMF just a day back, in that also the articulation is that the time has not yet come for a strict, normalization procedure. But indirectly, central banks started involving into that process because of the global uncertainties of mounting inflation. So that time, that growth first narrative has taken backspace. So that's a way it happened. But a huge strict normalization procedure right now can affect growth recovery process. So I can't agree with you both. So I do believe that this is not the time for tightening of the monetary policy space and fiscal policy space and the normalization process. Yeah.
Thank you, ma'am.
Next question, please.
Chat box, I can't see anything.
No, chat box, I think you have answered it.
Just Shihab.
This is the question by Shihab.
I think they are satisfied. No more questions.
If no more questions, we will wind up. It's very interesting question, discussion, and your presentation was excellent. Even though there are certain controversial issues in it, and which you may not be in a position to say what exactly is happening and why it is not done like that. There are issues. However, you made it very clear, and you took your stand. You safely placed your stand very. Because even the article that appeared in W and is very clear about the stand that you took it on this issue. However, we fully agree with there is a case for having monetary policy and fiscal policy together for stabilization. But we know that both are not going in the right direction in the Indian economy, even though people like you are advising the government. I think so. You agree?
Pardon me, I didn't understand that point of yours. That was a very huge accusation. You mentioned that the fiscal and monetary policy are not moving in the right path, but
no, not the right path. Not the right path. That is what I am mentioning. So stabilization is an issue that has to be addressed. That part you have taken care of, and almost all the questions and the queries you have discussed very, very well. Thank you very much for spending this evening with us, and also we are very happy that this session was an excellent and fruitful one. On behalf of the Center for Budget Studies and the faculty members of this department, I place our sincere gratitude to you.
Thank you, Professor Hari. And of course, you are welcome. Your controversial statements, you can write to me and we can have a one-to-one discussion later. And thank you so much for having me. Yes. Of course, you're welcome, and we can respectfully disagree over those points.
Okay.
Thank you.
There are issues that we agree.
We will take it up, yes. Thank you so much.
Are you in Trivandrum now?
Right now, that's what I told Santosh, yeah.
Yes, so Santosh told me. Are you in gift or somewhere?
No, not on an official trip.
Oh.
Yeah.
Oh, okay. Okay, thanks a lot.
Thank you so much.
Okay, thanks a lot. Right.
Okay, all the best for the students. Thank you so much.
Okay.